Welcome to my new podcast, The Investor Fear of a Great Depression. Can such a crisis happen again today? If you are interested in this topic, I think you will be interested in reading Dr. Polleit's Boom and Bust Report. All information at www.boombustreport.com. Don't miss it. And now let us begin with The Investor Fear of a Great Depression. Can such a crisis happen again today? In September 1929, the Dow Jones Industrial Average reached its then all-time high of 362.4 points. It then collapsed to 46.9 points by June 1932, resulting in an 87% loss. It took until August 1954, a full 25 years, for the index to recover to its 1929 level, not taking into account dividends. The period from 1929 to 1933 is known as the Great Depression. The stock market crash is the most visible symbol of that episode, but it should not obscure the many other dramatic developments that characterized the Great Depression. For instance, US real GDP fell by an estimated 27% from 1929 to 1933. Industrial production dropped by 50%. Unemployment rose from 3.2% to 24.9%. Wholesale prices declined by 29%. Around 650 banks failed in 1929 alone. By 1933, the number had risen to 4,000. In total, about 9,000 banks had collapsed between 1930 and 1933. The M2 money supply contracted by 31%. The Great Depression did not remain confined to the United States of America. It began there, but subsequently dragged almost every economy in the world into the abyss. Europe in particular was swept into a downward spiral of corporate bankruptcies, mass unemployment, bank failures and widespread impoverishment. The Great Depression, often called the biggest economic catastrophe in modern times, has been the subject of extensive economic analyses. Economists try to identify the ultimate causes of this terrible economic disaster and what countermeasures the US administration could have taken to contain the crisis and initiate a rapid recovery. Whatever the conclusions may be, one thing is clear from the stock market chart. The US economy only escaped the depressive period through America's entry into World War II, declared on December 8, 1941, one day after Japan's attack on Pearl Harbor. War production not only ended the Great Depression, it put the US definitely into the fast lane, paving the way for the country of unlimited opportunities to rise militarily, economically, and financially to become the dominant world power. Given today's sharply rising stock prices, artificially suppressed capital market interest rates, and extremely high debt levels, many investors are asking, could a Great Depression like the one seen from 1929 to 1933 happen again? In what follows, we attempt to provide an answer. It begins with taking a look at the monetary system that prevailed at the time. The United States of America operated on what is today called a gold standard, but it was in reality a pseudo-gold standard or a corrupted gold standard. A genuine gold standard has three characteristics. Number one, gold coins circulate. And number two, banknotes and customers' demand deposits are 100% backed by gold and can be exchanged for gold at any time. Number three, the money supply can only grow when new gold is deposited with the banks. Conditions 2 and 3 were not met in the US nor in European countries. For banks operated on a fractional reserve basis, that is, issuing more demand deposits and banknotes via credit expansion than they held in gold reserves. It is therefore more accurate to describe the 1920s monetary system not as a gold standard but as a pseudo or corrupted gold standard. When the fraud was exposed at the end of the 1920s, The banking systems collapsed, the money supply contracted, and the economy slid into severe recession and depression. Since 1834, the official gold price was 20.67 per troy ounce. Gold coins circulated, and banknotes could be exchanged for physical gold at commercial banks. However, as noted above, US banks operated with the tolerance of the US government on a fractional reserve basis. In other words, through bank credit expansion, banks issued more US dollars than they held in gold deposited by customers. The bank's immediately payable liabilities were therefore only partially backed by gold. In the 1920s, the decade following World War I, saw a massive boom in America. Real GDP grew by an average of 4.2% per year from 1921 to 1929. Industrial production rose 50%, real incomes increased by 20 to 30%, and credit and debt expanded dramatically. The boom was driven above all by low interest rates, artificially suppressed by the Federal Reserve, and a rapidly growing credit and money supply. Whatever the trigger that turned the boom into a bust and ultimately into a Great Depression, the fatal development was that many banks got into serious trouble. They suffered losses on their loan portfolios, and their equity capital shrank. Nervous customers demanded their bank deposits back in gold, but the banks, because of their fractional reserves, did not have enough gold on hand. Many banks became insolvent, and the deposits held with them defaulted, became literally worthless. The US money supply therefore contracted, and when the money supply in an economy shrinks, downward pressure is exerted on goods prices. And when consumers, producers, and the government have built up very high levels of debt, this becomes especially problematic. Imagine a highly indebted company. In a deflationary crisis, demand for its products falls, and the prices of the goods it sells also decline. Profits go down, and it becomes harder or impossible for the firm to service its debt. The company cuts costs, reducing staff, lowering investments, selling business units, etc. When all affected companies behave this way, the economy contracts, output falls, wages decline. Mass unemployment makes it impossible for more and more people to service their debt. Loan defaults at banks rise. Lenders restrict new credit, and banks demand repayment of maturing loans. The money supply shrinks further, creating a liquidity squeeze that reinforces the downward trend. The economy shrinks, good prices fall across the board. That, in broad outline, is what happened in 1929 onwards. Let us ask again, can something like this happen again? The crucial difference today is that, unlike back then, the money supply can now be expanded virtually at will and in any desired amount. For in today's fiat money system, the central bank can keep commercial banks liquid by providing them with short and/or long-term loans in the form of newly created fiat money. This allows a liquidity crisis and the credit or insolvency crisis that often follows to be nipped in the bud. Such crises are extremely dangerous for the fiat money system. If credit loses credibility, the debt-based fiat money system inevitably begins to totter or even fall apart. The central bank can also buy newly issued government bonds and pay for them with newly created fiat money. In a fiat money system, there is essentially no budget constraint. The state can use the money received to launch, for instance, aggregate demand stimulation programs and thereby support production and employment, so-called Keynesian deficit spending. Or the central bank can supply the state with new money so that, in a crisis, the state can recapitalize commercial banks if necessary. To this end, the government injects the newly created fiat money it received as credit into the banks as equity capital. The banks are then effectively, or at least in part, nationalized, but can later be reprivatized by selling the equity stake if politically desired. Against this backdrop, it becomes clear what happened from 1929 onwards. Bank failures and a contracting credit and money supply can in principle be prevented in today's fiat money system. However, and this is crucial for investors to note, in a financial and economic crisis, everything depends on how governments and central bankers act when faced with an approaching deflationary crisis. Two scenarios are conceivable. Scenario 1. At the first signs of a possible liquidity or credit crisis, the central bank intervenes immediately, providing banks with any amount of credit and money they need to prevent defaults. By acting early, the central bank smothers the crisis before it can erupt. The system-threatening loss of confidence in credit markets is avoided. Scenario 2. A crisis unfolds, but the central bank is too late in supporting debtors, commercial banks, and the state. Investors fearing defaults flee the credit market. Confidence in debtors evaporates. The central bank has then to monetize, that is, purchase bonds with newly created fiat money, an especially large amount of debt to keep debtors and the entire system solvent. The resulting flood of money frightens not only borrowers, but also money holders. Interest rates skyrocket. To bring rates down, the central bank must buy even more debt instruments and issue newly created money. What Scenario 2 describes is the path to a high inflation or even hyperinflation regime. It is the highly probable consequence if the central bank actually supports the fiat money system too late and then tries to correct its mistake. That said, the phase in which the central bank does not intervene is therefore the potential window during which a Great Depression-like scenario, similar to 1929, could emerge. The US Federal Reserve and the European Central Bank and other central banks in Europe have so far always reacted immediately, directly, in crises, cutting interest rates and expanding credit and money supply. Just think of the bursting of the new economy bubble in 2000-2001, the global financial and economic crisis of 2008 and 2009, or the politically imposed lockdown crises of 2020 and 2021. The Bank of Japan acted differently for a long time, though. From 1989 to 2009, Japan experienced asset price deflation. Land prices fell by about 55%. Stock prices lost up to 80% at their low. Yet there was no permanent recession or mass unemployment, and there were no credit defaults on a grand scale. With the subsequent shift to a policy of monetizing government debt and expanding the yen money supply, land and stock prices were massively re-inflated. Against this backdrop, the following conclusions are crucial for investors. Recessions, especially when accompanied by broad-based goods price deflation, are feared above all else by both rulers and the ruled. Such a scenario will therefore be fought with every available means, essentially under the motto, whatever it takes. Cutting interest rates and expanding the money supply are regarded, especially when goods price deflation is feared, as the policy of the comparatively lesser evil. One reason is that such a policy promises immediate benefits, extinguishing the flames of crisis, while the damage it causes, that is destroying the purchasing power of money, only becomes visible later with a time lag. What makes this policy reaction even more likely? Highly indebted groups, above all the state and the banking and financial system, have an especially strong incentive to solve their over-indebtedness problem with inflation rather than with defaults. For these special interest groups, the ideal is an inflation that goes largely unnoticed and remains disguised. But in the extreme case, they can be expected to accept even very high or hyperinflation to avoid defaults on a grand scale. Given all this, the implications for the investors are as follows. Number 1. The erosion of money's purchasing power is and remains the central problem for the investor. And note that the officially published inflation rates systematically understate the true loss of purchasing power of money. Number 2. Even in an environment of ongoing money supply expansion, the investor is not protected from capital losses. Anyone who buys overvalued assets is exposed to the risk that asset price valuation levels will go down temporarily or permanently. Therefore, do not buy when prices are too high. And number 3, continue to hold a relatively high liquidity position. For example, 40% in cash, physical gold and silver, especially so if you do not identify better investment opportunities, with the remainder invested in inflation-resistant company stocks, namely those we have presented in earlier editions of Dr. Polleit's Boom and Bust report. If you want to learn more about what to do next, I recommend you read Dr. Polleit's Boom and Bust report. All information at www.boombustreport.com. Thank you very much for your attention.